So 2025 was our best year yet at Mansa-X in terms of returns. For the 7 years that we have run this fund, we actually had our best annual return for both funds actually. So the Kenya Shilling Fund returned 20.74% net of fees. This compares to 19.53 in the previous year. The dollar fund returned 13.37%, again net of fees, compared to 12.5% the previous year. These returns have actually created a lot of excitement for us, and we believe that we have continued to prove to our investors that we can perform, give them better than average returns on their portfolios. So the number of clients that we serve within our Mansa-X funds, our investors, actually grew from 22,000 investors to 55,000 investors. That's about 150% growth. Again, something that caused us a lot of happiness to see that investors have continued to believe in the product and to join these Mansa-X funds. And our AUM growth is also demonstrably higher, closing the year at about 122 billion shillings from 47 billion shillings a year prior. That's about 160% growth. To put this in perspective, that's just shy of $1 billion. The largest fund essentially of our type in this side of the world, not just in Kenya, but essentially in sub-Saharan Africa, outside of South Africa. So this is something we are very proud of as a Standard Investment Bank. So 2025 was an interesting year. A lot of things happened, and it's these things that create the volatility that a fund like ours takes advantage of. And it's important, even before I say the things that happened in 2025, for investors to understand that news of whatever type, good or bad, tends to be actually good for a fund like ours, which runs what you call a long-short model, meaning that if there's volatility in the markets, it tends to be useful for funds like ours in terms of opportunities that it creates. And from those opportunities, that's where we derive the return that we give to investors. The reason I say this is because we've seen a lot of investors asking us, this and this news have come out. Are our funds okay? Are you going to have a better return, or are your returns going to be affected? You should know that for us, that's exactly what the fund is designed to do. So we started the year with a bit of concerns about AI. We saw a cheaper model of AI coming from China. At the time, it was called DeepSeek. So we started last year with markets actually coming off because a lot of market players thought that maybe AI was overhyped, especially in the American region. But this obviously was proved to be wrong, and the markets rebounded. So the general theme of 2025 is a lot of fears coming out, then those fears being shown to be overhyped. The second concern we had, and this is a concern that was throughout the year in 2025, was concerns around tariffs. And initially this spooked the markets, especially what you call Liberation Day. That was early 2025 when Trump announced all these very heavy tariffs and so on. But markets eventually realized that these tariffs were really tools of negotiation rather than market disrupting, rather than something that would actually create disruption to the markets. So again, this tended to actually have the opposite effect. Markets actually rallied around these kind of tariffs and the repealing of them. Another concern in 2025 was around the independence of the Fed. A lot of concerns being about the comments that were being made by the Trump administration, with talking about changing who the Fed chair was going to be and so on. Again, this is something, it remains a bit of a concern, but what we see now is that the market is fully awaiting who will be the new Fed chair. We expect an announcement this year in 2026. But from what we saw in 2025, the Fed still acted independently in spite of any comments from the Republican administration. And we actually saw Fed rate cuts, 3 Fed rate cuts in 2025. In September, October, and December, we saw 25 basis points rate cuts each month. again, this was really just guided by monetary policy, and it completely ignored the political conversation. So again, this helped the markets to continue rallying, because the markets were able to see that there's actually Fed independence, no matter the comments that came from the White House. Then one of the other things we saw mid-2025 was the one, what Trump refers to as the one big beautiful bill that cemented the tax cuts that were implemented in his first tenure. And this injected liquidity by putting money back into Americans' pockets. So a lot of taxes were repealed, especially on small income earners. And this put money back into people's pockets, again, stimulating the US economy. One of the reasons why we actually saw a much better economy in the US last year. An interesting thing in 2025, and I'm sure a lot of our investors who have been following these YouTube videos will have noticed, is the rally in precious metals. So gold and silver, were the star performers in 2025, with gold rallying as almost 65% year on year. That's a massive jump in any asset class. Silver was even more interesting to see jump by almost 150%. Now the reasons for this are almost similar. Gold and silver tend to be safe haven assets, gold particularly. So when there's a concern around, policy and so on, it creates the need to create a place to, park funds that does not have a currency correlation. And that's where you see metals tend to rally when there are some periods of uncertainty. So that's the reason we saw gold and silver rally. Silver has the added advantage. Silver is the best conductor of electricity. So as AI continues to drive investments in chips and data centers, the demand for silver will continue to rise and rise. So silver has become the most sought after metal essentially on this planet. So that's why silver continues to rally on a twofold reason: as a safety haven and because of its actual requirement in building of chips. We also saw some geopolitical tensions last year. We expect this to continue. For example, we saw Israel, attacking Iranian sites last year. The expectation obviously would have been that maybe the oil prices would have, risen as a result. But one of the things we've also noticed globally is that there's been a massive supply of oil. So in spite of all this, year-on-year oil actually lost value by about 20%. So this is really just interesting to see how, no matter what's happening in terms of news, demand and supply at the end of the day will still determine the price of any commodity. In the Asian region, we saw Asia, especially Japan, for the first time start changing their approach to interest rates, going from an ultra low interest rate period to now actually switching to increasing their interest rates somewhat. And interestingly, we saw the Nikkei up about 26% last year. So Asia will be particularly interesting to watch in the coming year. But in 2025, it also performed very well. On the currency front, we actually saw the dollar lose about 10%. There's been general talk of a de-dollarization. So the dollar has generally been shedding off some of its value, and 2025 was no exception, losing about 10%. And if you look at what's happening in the European continent, there's a rotation therefore to capital that way. So you see a lot of European currencies actually gaining against the dollar. The top performer in Europe was actually the Swedish krona in that regard. It was the highest gaining currency against the dollar. The euro also did very well against the dollar, and we expect that this might continue as long as the de-dollarization theme continues in the markets. So locally, we saw the Kenya shilling remain very stable against the dollar, hovering around the 129 levels. So the shilling has continued to have exceptional performance, and we expect this stability to continue. So this is in spite of the CBK actually easing interest rates. We started 2025 at around 10.75%, ended the year at 9%. So yields are coming off. This again continues to be an incentive for the stock market to continue performing better. and that can be actually seen with the numbers for the NSE in 2025. The Nairobi Stock Exchange gained by above 50% year on year. That's a massive performance, led by banking stocks and Safaricom. We expect this growth also to continue, and from our end, it's also created a lot more opportunities, even in the local markets, which creates very exciting times for all of us. This information about our top 10 assets is actually, it's included in our fact sheet, and this is something that I'd encourage all our investors, new and existing, to always read. We try to give you a small brief about how the markets actually performed and why it did the way it did. It's just to give you an idea of how the fund actually makes the return it does. But if you flip on the back of the fact sheet, you will then see the fund performance. So we talk about the returns as made on a quarterly basis for at least 2 years prior. And then we show you where the geographical distribution of the funds are and what our top 10 holdings are. So we can just start with, if you look at the year 2025, you'll see the quarterly returns was 4.89 for the first quarter, 6.05 for the second quarter of 2025. That was actually our highest performing quarter last year. Then about 5% and 4.7% to close the year. That's what gives you the return of 20.74. Again, depending on when you joined the fund, your return can differ slightly. Just to give you an example, if you joined the fund, say, in Q2 of 2025, mathematically speaking, you joined when the fund was performing better. So you might have a better return, say, than someone who joined prior to your investment and so on. And it's very important for investors to understand that what we refer to as a return looks at the entire performance for the whole year. And joining within the year can give you a slightly different return because of how the market was performing at the point you invested. So our top 10 holdings, the number one top 10 holding was fixed income instruments, and also followed by interest rate derivatives. So fixed income instruments are your sovereign debt bonds. So we're talking about bonds like Euro bonds, treasury bonds, both local and international, like US treasuries and so on. So the reason we hold this is because first, they are liquid and interest rates have also been coming off. So they tend to also, from a capital gain perspective, they also have very good returns. Then our third top holding was S&P 500. This S&P 500 grew by 16% last year. So it was a very good asset class to hold. We were holding Alphabet as well. Alphabet has done very well. Alphabet is a holding company for platforms like Google and Gemini, which is now a big deal in the AI sector. And Alphabet grew by 65% year on year. So spectacular numbers out of that. Then we have AMD, Advanced Micro Devices. AMD continues to be a good company to own, obviously because of the AI growth. Again, the growth of the chip making industry has been quite spectacular. And AMD grew by 77% last year. From a financial stocks perspective, we were still heavy on financial stocks. Our largest holding there was Goldman Sachs. And Goldman Sachs grew by 53% last year. Eli Lilly, we continue to be biased towards pharmaceutical companies, and Eli Lilly grew by 39% in 2025. I'd mentioned silver earlier and how important it is for us in the fund to hold silver, and silver grew by almost 150% last year. It represented about 1.5% of the fund's portfolio. Cash and cash equivalent, really this is just cash. Essentially, if cash has not been deployed into any investments, that's what we refer to cash and cash equivalents, which is about 1.25% of the fund. This is also what allows a fund to remain liquid. It's very important to note that you cannot be completely zero cash in a fund due to, of course, dealing with withdrawals or maybe dealing with investment opportunities as they arise. Then our number 10, top 10 holding was actually Vanek Gold Miners. This is an ETF representing gold miners and companies. So this was about, again, 1.2% of the fund, and it grew by 152% year on year. So spectacular performance from our top 10 holdings. And a question has been asked maybe for the last few YouTube videos that I've done. People have asked, why is it that your top 10 holdings, you don't seem to have one that's losing? All I can say is that markets have been doing well essentially for the last 2 or more years, and especially for last year we were mostly in long positions, so they tended to do well. But it's important to note that we do have short positions in our fund, and obviously those short positions would typically be loss making if the market is on a bull rally like it was last year. Again, if you look at our top 10 holdings, they only represent about a third of the fund. So about 70% of what we hold is not listed in this top 10. And that's easily about more than 60 other instruments that you're not seeing here. And within those, you have profitable ones and non-profitable ones. So we don't cherry pick the profitable ones to show you on the fact sheet. It's really just representative of the strategy of the fund and how it was last year. If you look at the if you look at the dollar fund, the top 10 holdings are very similar, except the index. We switched S&P for NASDAQ. NASDAQ actually did almost similar to S&P, gained almost 20% last year. We also had AMD, we had Eli Lilly, we had Alphabet, but another difference here is that we hold gold here directly through gold futures, and I had mentioned gold was up over 60% last year. So still very good performance. We were also looking to benefit from increased consumer spending by holding Walmart, and Walmart was up 23% in 2025. Again, from financial stocks perspective, we were holding the Canadian Imperial Bank of Commerce, which was up about 43% last year. So the holdings in the dollar fund and the Kenya shilling fund tend to be similar in terms of the sectors that we are in. But due to the fact that the entry points might differ, we might choose a different company because of the entry point, meaning that you will see the sector being similar, but not necessarily the same company. Another thing investors have asked us is, why does the shilling fund perform better than the dollar fund, yet exposure is sort of the same? Well, it's not really. There's something called a yield differential, and a currency like the shilling, because of the yield differential, meaning it's a higher yielding currency, will tend to outperform a dollar investment by the same differential. This is really just an economics thing, and if you look very closely, you'll find that when we talk about, say, fixed income instruments, there will be a yield advantage for the shilling because of that, and also for cash and cash equivalent, there will be a yield again advantage that's created there. These are some of the reasons why a Kenya shilling fund will do marginally better than a dollar fund, but it will be represented by what you call a yield differential. Geographically speaking, we were mostly in the American region. For both funds, more than 50% of the funds being in the American region, followed by Africa for the Kenya shilling fund, and Europe for the Kenya shilling fund being the number 3 geographical location. If you look at the dollar fund, the Americas is the highest, followed by Europe, and then Africa third. So as you can see already what I was talking about in terms of yield. So the shilling fund is obviously seeking yield in the African region because of the Kenya shilling denomination, and the dollar fund seeking rotation into America and to European regions. So the reason why we also distribute funds, not just in assets, but also geographically, is also to remove exposure to any one geographical region going through a crisis and the entire fund being affected as a result. And this is one of the reasons why we say Mansa-X is easily one of the best diversified investments you can make. We protect investors' funds by being diversified in terms of assets that we are investing in, as many assets as possible which are uncorrelated. So we are in stocks, we are in metals, we are in commodities, we are in indices. But we also make sure that at the same time, those same assets are traded through a long-short trading model, again offering further protection for our investors. Then we again distribute all these assets into different geographical regions, another layer of diversification. So all this leads to an investment that's very highly diversified and with very significant protection to downside risk. So for 2026, we expect really just a continuation of the momentum we saw towards the end of 25. That tends then to carry on into 2026 and gives us an idea of what we will expect. So towards the end of 2025, one of the things we saw was a sector rotation from tech stocks to now what you call the old economy stocks. So before, the market used to be really held by the Magnificent Seven. That's why there was a bit of a concern of, is this market comparable to when there was a tech bubble? But now, by the mid to end of 2025, in fact, the tech stocks actually underperformed the entire market, with only Nvidia and Alphabet, doing better than the market. So that tells you that the stock market growth is actually resilient because it has, it's a sector-wide growth for the stock market. So moving into 2026, we expect to continue seeing a rise in mining stocks. We expect to see a rise in industrial stocks, consumer staples. Banking will be a big one, we expect, and also utilities. So this is a good sign of the health of the economy when you have this kind of healthy mix in terms of the companies that lead the overall stock market growth. Of course, we'll also be looking at geopolitical tensions. The year has started with concerns around, U.S. doing what they did in Venezuela, and concerns around whether that's even allowable from an international law perspective. Concerns around the threats being made upon Greenland by the Trump administration. We also have now a protest in Iran and what the world will do about it. So we expect that defense stocks, which form part of our portfolio, we expect that they'll continue to do very well. As countries start to show up their defense budgets, especially in Europe, where we've been seeing an increase in defense budgets at the highest levels for the longest time. So we expect that this will continue, and this will continue to boost defense stocks. We'll also be looking at the Supreme Court ruling in the US on tariffs. They have been postponing to give this ruling, but eventually they have to give a ruling on this about the legality of the tariffs and how they've been implemented. So this is also something that markets will be observing very closely. Of course, this is a big year for the Federal Reserve, where we expect a new Fed chair to be installed in May. In fact, the decision is expected very shortly, and we will obviously, the market is looking to have a Fed chair who is dovish. Dovish means a Fed chair who will actually be looking to increase the rate cuts. If we have a Fed chair who is seen to be dovish, this will definitely be good for the markets, and this is what we believe will happen. Globally, we expect a resurgence of emerging market economies like India, Mexico, and the greater Latin America, but also African countries as well, as the world also diversifies their supply chain logistics, moving now into countries like Mexico and so on. So we expect that this will actually boost emerging market economies, and we'll be looking at those very closely. In Africa, we expect the Eurobond market, the fixed income market, to do well as yields come off and also as risk sentiment increases. Countries like Senegal, for example, have resumed talks with IMF. We expect that this will boost the performance of Eurobond from that side of the world. And generally, because of risk sentiment being higher, we expect that African Eurobonds, especially the Kenyan Eurobonds, will continue to do really well. So that's another sector we'll be watching very closely. From a commodities perspective, we expect that oil might remain subdued unless OPEC changes the supply dynamics. But right now we have an oversupply of oil globally, so we expect oil prices to actually remain subdued for now. And for metals, so gold and silver, we again expect that they will remain supported, and in fact, we expect them to trend even higher as central banks continue to show up their reserves as they try to de-risk from having excess holdings in the dollar. So again, the de-dollarization that we are seeing globally might actually continue to boost precious metals. The local stock markets, the rally that we saw last year, we expect this to continue, again led by banking stocks. We really expect this to continue this year. And we also think the NSE will also benefit from a better sentiment, a very positive sentiment, especially around the expectation that the IPO market is back. We expect our first listing on that stock market in a long time as KPC comes into the market for an IPO. This is expected to again be the tide that lifts all boats locally. So generally, globally, locally, and from a Pan-African perspective, we are very positive that we will have a very interesting 2026, and we look forward to taking advantage of these opportunities to give our investors a good return. Again, with markets and with how the world really is, we don't expect that everything will go according to plan. But this fund, as I keep emphasizing, is designed to be very ready to to just shift to align with whatever changes we see, and those changes are what will allow you to continue having a good return on your portfolio in spite of anything that comes up in the market. So we remain vigilant and watchful and ready to continuously adjust the portfolio for all our Mansa-X funds accordingly to continue giving an above average return while still disproportionately reducing the risk that the fund subjects the investors' funds to. We really want to thank our investors for continuing to support this product. The Mansa-X funds have grown, purely due to the support we've received from investors for the last 7 years. So we remain very thankful for this, and we will continue to do everything we can to continue to satisfy our investors' expectations. We will continue to continuously give returns that offer above average returns while minimizing the downside risk. So that remains the most important thing for us, on top of other things like making sure we have a fund that's liquid enough to handle any unforeseen circumstances in the future. So we're very thankful for our investors for this, and we continue to be very vigilant with the trust that they have placed on us. So we don't take it for granted and do everything we can to ensure that funds invested in Mansa-X are duly and diligently cared for. That said, we've also had a few questions and feedback that investors have been giving us. One of the questions we saw people asking us was, you have built a very big building called SIB International Center. Does this have any impact on our investments, and doesn't that create a concern in terms of liquidity and so on? So just want to be very clear. The Mansa-X funds are held under a trust called the Standard Investment Trust Funds. Now, this trust is very separate from Standard Investment Bank. So our investors' funds and investments are held, just to emphasize, under Standard Investment Trust Funds, which now is a trust fund that holds Mansa-X Shilling Fund, Mansa-X Dollar Fund, Mansa-X Sharia Kenya Shilling Fund, and Mansa-X Sharia Dollar Fund. And that is, from a regulatory perspective, distinct from funds held within Standard Investment Bank. Now, SIB International Center, as you can see even from the nomenclature, is owned by SIB. So that means that we do not actually commingle client funds with investments into something like the SIB International Center. So investors can rest assured that your investments continue to be applied in the markets that we have outlined in this video, and not in asset classes that our investors have come to realize are not what we have always had as a part of our investment strategy. Some of the other feedback we are getting from our investors is to improve our operational efficiency, and one of the things that we are doing and prioritizing this year is automation. So we'll apply a lot of automation in how we run the Mansa-X funds so that we can have a better customer experience for our investors in terms of checking statements, making withdrawals and deposits, and other operational matters like those. So there's a lot of automation that we are implementing in 2026 as a priority item to improve customer experience. So once again, thank you very, very much for continuing to believe in the product and for continuing to invest with us. And we wish you all a happy new year and blessed outcome of 2026. Thank you.